All right, let's dive into something I found truly eye-opening as we prepared for this. Um, when I used to think about owning a company, it was always just common stock, right?
Right. That's what most people focus on.
But our sources for today, well, they reveal that's just the surface. There's this whole world of other equity forms that, frankly, surprised me with their unique twists and turns. So today, we're taking a deep dive into some fascinating, yet maybe often overlooked forms of equity. We're talking preferred stock, floating stock, secondary offerings, and even fractional shares.
Yeah, some really interesting corners of the market.
What's truly surprising, I think, is how these seemingly niche areas actually reveal the hidden strategies companies use to raise capital. And, crucially, how they can offer you unique ways to maybe navigate volatility or unlock opportunities you might have missed with just common stock.
Exactly.
Our mission today is really to cut through the jargon and give you those aha moments.
And what truly stands out about these areas is how they directly inform the larger market picture. Each one offers unique advantages, unique considerations that can significantly impact a company's financial structure and, well, an investor strategy too.
Right.
Getting a handle on these nuances provides a much more complete and, frankly, more empowering view of company ownership and market dynamics. It's not just one simple thing.
So let's kick things off by pulling back the curtain on preferred stock. It's truly a fascinating beast, often misunderstood, I think.
It really is.
At its core, preferred stock is company stock issued at a fixed par value. You mentioned it's like a hybrid.
Yeah, think of it like that. It combines features from two different worlds, common stock and bonds. It takes, some risk from one and some stability from the other.
Okay. And the crucial distinction is it usually doesn't give you voting rights, but it does have priority over common stock for dividends.
Mm.
And significantly, priority if the company goes bust, right,
Well,
in bankruptcy.
exactly right. Preferred stock absolutely represents ownership and a direct claim on a company's income. So preferred stockholders, they have a higher claim on those distributions, like dividends, than common stockholders do.
Okay.
And while they typically have no or maybe very limited voting rights in corporate governance, their claim on assets in a liquidation scenario is definitely greater than common stockholders.
But still behind bondholders.
Oh, absolutely. Still behind bondholders in that pecking order. But this unique blend of features, fixed dividends like debt, but with that potential for price appreciation like equity, makes it appealing to investors looking for stability and potential future cash flows.
So how do those dividends actually work for preferred stock? Or are they just like guaranteed to just tick along like clockwork?
Not always guaranteed, no.
Oh.
But they generally yield more than common stock, and they can be paid monthly or quarterly. They might be fixed.
Hmm.
Or they could even be benchmarked against something like LIBOR, which means the dividend can actually fluctuate with market interest rates.
Oh, okay.
You also have things like adjustable rate shares, where certain factors influence the yield, and participating shares, which can pay additional dividends tied to common stock dividends or the company's profits.
Wow.
But here's the key thing to remember. The board of directors always has the final say on whether to actually pay that dividend. It's not automatic like bond interest.
That's fascinating. That blends of fixed and adjustable.
Yeah.
But if I'm an individual investor looking for that stability, how do I gauge the risk that the board might decide not to pay, even if it's supposed to be fixed?
That is an excellent question, and it brings us to a really interesting point. Not all preferred stocks are created equal. They come with different features that directly address things like missed payments or future opportunities.
Okay.
For instance, some preferred stocks deal specifically with what happens if a dividend is missed. You've got cumulative preferred stock.
Right.
This ensures those missed payments pile up, they accumulate, and they must be paid in future periods before any lower tier shares like common stock get anything.
Got it. So you eventually get paid back.
Hopefully, yes. In contrast, you have non-cumulative preferred stock. With this type, if you miss it, you lose it. Those dividends are not made up in the future, it's treated year to year. This non-cumulative type is actually quite common in banking, often because of regulatory rules.
Okay, so those are about missed payments. What other flavors, as you might say, are out there?
Well, other types offer different pathways or priorities. Convertible preferred stock is a popular one. It's good for investors who want that stability, but maybe don't want to completely miss out on potential growth.
Oh, yeah.
It offers the flexibility to trade your preferred stock for common stock. Usually it's a one-way street with specific guidance on the exchange ratio.
Makes sense.
Then you have types that determine the payment hierarchy. Prior preferred stock holds the highest rank for dividends or creditor awards. It takes precedence over other preferred stock issuances.
The top dog.
Pretty much.
Mhm.
Then preference preferred stock is the next tier down, still holding greater priority than other preferred issuances below it if there are multiple tiers.
Okay.
And finally, the most common type you'll probably encounter is perpetual preferred stock. This usually means your initial capital isn't returned directly. You have to actually sell your shares on the market to redeem them, though some do have fixed end dates, more like bonds.
Right.
And we briefly mentioned participating preferred stock earlier. These can receive additional dividends tied to company achievements like sales or earnings on top of their normal dividends, assuming the company has the means, of course.
Wow. Okay. So you don't need to memorize every single type, maybe?
No, definitely not. But understanding these broad categories really helps you quickly size up a preferred stock's risk-reward profile.
That's incredibly helpful for understanding the nuances.
Yeah.
So what does this all mean for you when you're weighing your options? Let's do a quick side-by-side.
Good idea.
When we look at preferred stock versus common stock, well, they both represent equity ownership, right? And they're tradable on public exchanges.
Yeah, those are the basics.
But that's kind of where the core similarities end. For dividends, preferred has the first right, and they're often fixed. Common stock, no guarantee at all.
None whatsoever.
In terms of capital appreciation, potential growth, preferred typically sees less. Common often offers higher potential, but more risk.
Right. Higher risk, potentially higher reward.
Voting rights?
Yeah.
Preferred usually none. Common usually yes.
Aha.
Convertibility. Preferred may convert to common, but common can't convert back to preferred.
Nope.
And in liquidation, if things go south, preferred gets better treatment. Common shareholders are kind of at the back of the line.
Way at the back. Now, to really complete the picture, it's also helpful to compare preferred stock to bonds.
Okay, how do they stack up?
They share some similarities. Both often issue periodic cash payments, and they're often issued at a par value like $100 or $1,000.
Uh-huh.
However, the differences are pretty significant. Preferred dividends, as we said, can change or even stop. And they're often taxed at a lower rate than bond interest, which can be a huge draw for certain investors, especially corporations.
Ah, the tax angle.
Exactly. Bonds, on the other hand, usually have fixed interest payments and a clear maturity date, when you get your principal back. Preferred stock often has no end date. It can be perpetual.
Right.
And crucially, if a company is liquidated, bondholders get preferential treatment. They get paid before preferred shareholders.
Okay, that's important.
And here's a key distinction. Failing to pay a dividend to preferred shareholders does not mean a company is in default. That's a huge difference from bonds, where missing an interest payment is a default event.
Got it.
Because preferred shareholders don't have the same guarantees as creditors, the credit ratings on preferred shares are generally lower than bonds from the same issuer. And because they're riskier.
They usually offer higher yields to compensate.
Exactly. Higher potential yield for taking on that extra bit of risk compared to the company's bonds.
That makes sense for institutions, I guess, especially with those tax advantages on dividends received from other corporations. But for the average individual investor, maybe without those same tax breaks, is there still a compelling reason to consider preferred stock over, say, a high-yield bond? It feels like some benefits are lost.
That's a very fair point. For individual investors, yeah, the primary appeal often lies in that higher, usually more consistent dividend yield compared to the company's common stock. Plus, that higher claim in liquidation offers a layer of safety that common stock just doesn't have.
Okay.
So while the tax advantages might not be the same as for institutions, preferred stock can still offer a compelling income stream, especially in a volatile market where, consistent dividends look pretty good.
Yeah, stability is key sometimes.
So while institutions are major buyers because of those specific tax rules, they can often exclude a large portion of preferred dividends from their taxable income. Individual investors still find them attractive for that stability and cash flow. We see companies like General Electric, Bank of America, Georgia Power. They've all used preferred stock to raise capital, often when regulatory constraints limit their ability to take on more debt, or maybe to finance specific big projects.
Okay, so even with those advantages, let's be clear. Can you still lose money on preferred stock?
Yes, absolutely. No question. Like any equity investment, its value can definitely decrease if the underlying company struggles financially.
Right.
Your investment is still tied to the company's health and performance. So there's always a risk of loss or at least a decrease in market value, especially if, say, overall interest rates rise, making those older fixed rate preferred shares less attractive compared to newer issues.
So we've looked at the different kinds of shares you can own, but what about how easily you can actually buy or sell those shares once they're out there floating around in the market?
Uh,
That brings us to another crucial concept for investors, what's commonly called floating stock. What exactly is this float, and why should we care?
right, float. It's simply the number of shares a company has that are actively available for trading by the public.
Oh, yeah.
Think of all of a company's shares, like every single seat in a big stadium. The floating stock is just the number of seats actually available for public sale for today's game.
Gotcha.
Seats reserved for season ticket holders, or maybe for the owner's family, those aren't floating. They're not really available. That's why the float is calculated by taking the total outstanding shares and subtracting any closely held shares, which are owned by insiders, major long-term shareholders, or employees, and also restricted stock. Restricted stock is like insider shares that have temporary trading restrictions, maybe after an IPO lockup period ends.
So why should you, the everyday investor, care about this float number?
Yeah.
How does it impact things?
Oh, it's critical for your trading experience. A stock with a small float is generally more volatile. Why? Because with fewer shares available, it can be harder to find buyers or sellers when you want to trade.
Makes sense.
This often leads to larger bid-ask spreads, the difference between the highest price a buyer will pay and the lowest price a seller will accept, and usually lower trading volume, too.
So harder to get in and out.
Exactly. Low float can impede active trading, making it difficult to enter or exit positions smoothly or at the price you want. Institutional investors, the big guys who buy large blocks of stock, they often steer clear of smaller floats because of this limited liquidity and the wider spreads. They prefer larger floats so their big purchases or sales don't impact the share price as much.
Okay, so the float isn't static then. It can actually change over time. How does that happen? What makes it go up or down?
Right, it definitely changes. It increases when a company issues new shares to raise capital, or when restricted or closely held shares become unlocked and available for public trading. Stock splits also increase the number of floating shares proportionally. Conversely, the float decreases when a company does share buybacks, repurchasing its own shares from the market, or through reverse stock splits, which reduce the share count.
Okay. And what doesn't change the float? Does my buying or selling affect it?
Good question. No, investor trading, buying, selling, even shorting shares doesn't change the float itself. Those are just redistributions of the existing available shares. The total number available stays the same. Similarly, the creation and trading of options on a stock also don't affect the float number.
Let's use a real-world example maybe to make this concrete. You mentioned GE earlier.
Yeah, GE is a good example. As of, say, September 2023, General Electric had about 1.088 billion shares outstanding in total.
Wow. Okay.
But the float was only about 260 million shares. So a huge chunk, roughly 76% or 830 million shares, weren't readily available for public trading at that time because a significant portion was held by insiders and large institutions, likely for the long term.
That's a massive difference.
It really highlights the concept. And it's worth noting, too, that institutional ownership numbers change all the time. If you see institutional ownership falling and the share price falling, that could signal that big players are selling off shares. If ownership is increasing, they might be accumulating.
So it sounds like float isn't inherently good or bad, maybe, but it's a critical factor in how a stock behaves. If it causes volatility, is that mainly a concern for short-term traders, or should long-term investors care too?
That's a great question. While short-term traders absolutely need to watch the float for managing quick entries and exits, long-term investors should consider it too.
Why is that?
Well, a very low float can mean that even if you plan to buy and hold, if you ever need to sell a large position or even a modest one during a market downturn, you might struggle to find enough buyers without significantly pushing the price down against you.
Okay, so it's about liquidity even for the long haul.
Exactly. It's about both liquidity and potential price stability. Generally, stocks with a smaller float tend to exhibit higher volatility. Stocks with a larger float typically have lower volatility and are easier for investors, large and small, to enter and exit positions.
Got it. And just to clarify, you sometimes hear stock flotation or float shrink.
Right. Stock flotation is just the process where a company issues new shares to the public, usually to raise capital. Float shrink is the opposite, like when a company conducts share buybacks, reducing the number of available shares. The key is always that distinction. Floating shares are available to trade, non-floating shares are held by insiders or major long-term holders and aren't really part of the daily market action.
Okay, we've just explored how the availability of shares, the float, impacts trading. But what happens when a company, or maybe even a major shareholder, decides to intentionally put more shares into the market after the initial IPO?
Right.
That's where we get into the strategic world of secondary offerings. And this term I found can be a little tricky because it actually refers to two different situations, doesn't it?
It does, yeah. That can be confusing. The term secondary offering can mean two distinct things. First, it can refer to when a major investor, like a company founder, an early venture capitalist, sells their existing stock to the public on the secondary market.
Okay, so they're cashing out some shares.
Exactly. And in this case, the money, the proceeds, go directly to that seller, not the company.
Got it. What's the second meaning?
The second definition, which is also commonly called a follow-on offering, or FPO, is when the company itself issues additional brand new stock after its IPO to raise more funds.
Ah, so the company gets the cash this time?
Precisely. The proceeds go to the company's treasury.
So how do these offerings fit into the life cycle of a company's stock? Where do they happen?
Well, the IPO, the initial public offering, that's the very first time shares are offered to the public. That happens on the primary market. Secondary offerings, whether they're from existing investors selling or the company issuing new shares, happen after that IPO on the secondary market where stocks normally trade.
Okay. And why would a company do a follow-on offering?
Usually to raise capital for specific purposes, maybe financing debt, making acquisitions, funding R&D, expanding operations, things like that. Sometimes large existing investors might also signal to the company that they want to sell a big chunk of their shares, prompting the company to facilitate that through a non-dilutive secondary offering.
Okay, so let's break down those two crucial types you mentioned again. The ones where the seller gets the cash versus the company.
Right. The first type is the non-dilutive secondary offering. Critically, no new shares are created here. So existing shareholders aren't diluted, their ownership percentage doesn't shrink.
Okay.
These shares are sold by existing private shareholders, could be directors, executives, insiders, venture capital firms. Often they do it to diversify their own holdings or simply to cash out some of their investment.
And this increases the float.
Yes, exactly. This type of offering increases the total number of shares available for trading, the float, which can actually benefit trading liquidity. It's pretty common to see these happen after an IPO lockup period expires when insiders are finally allowed to sell some shares.
Makes sense. And then there's the other side of the coin, the one where new shares are created.
Exactly. That's the second type, dilutive secondary offerings. You might also hear this called a subsequent offering, or as I said, a follow-on public offering, or FPO.
Okay.
This is when the company itself creates and places new shares onto the market. This increases the total number of outstanding shares, and as a result, it dilutes the earnings per share, the EPS, for all existing shareholders.
Right, the pie analogy. More slices, smaller slice per person.
Precisely. Imagine the company's total earnings are a pie. If you suddenly add more slices to that pie by issuing more shares, each existing slice, each share represents a smaller piece of the pie. This dilution can often put downward pressure on the stock price, at least initially.
So why do it then if it can hurt the stock price?
Well, the company does it because it needs to raise cash, usually for its longer-term goals, maybe paying off significant debt, financing a major expansion, or funding a strategic acquisition. And a fast fact for you. Secondary offerings are normally marketed very quickly, often just within a few days compared to the weeks and weeks it takes to prepare for an IPO.
So how does the market typically react to these announcements? Does it always spell bad news for the stock price? Or can it actually be seen positively?
It's definitely mixed. It can certainly be perceived negatively. Investors might worry or anticipate bad news if a large shareholder, especially a company founder or key executive, suddenly sells a significant chunk of shares in a non-dilutive offering.
Yeah, that might look like they're losing faith.
It can look that way. For example, Capri Holdings stock apparently fell over 10% after they announced a 25 million share offering. But sometimes the market has an unexpected positive reaction, particularly to a dilutive offering where the company gets the cash.
Really? How so?
If investors believe the proceeds will truly benefit the company in the long run, Maybe by paying down burdensome debt, funding a really smart acquisition, or investing heavily in future growth opportunities, the stock price might actually increase.
Interesting.
Yeah, CRISPR Therapeutics, the gene editing company, saw its stock price jump nearly 14% after announcing a 5 million share offering back in 2018. Investors clearly saw it as a smart strategic move to fuel future innovation.
Wow. And we've seen other big examples play out in the real world, right? I remember Mark Zuckerberg of Meta, back when it was Facebook, sold over 41 million shares in 2013. That raised about $2.3 billion, partly to pay a massive tax bill.
Right, a huge non-dilutive offering.
And then Rocket Fuel in 2014 announced a follow-on offering of 5 million shares for $305 million, really capitalizing on a high share price at the time.
A dilutive one, raising cash for the company.
And even Google, now Alphabet, just a year after its IPO in 2004, conducted a massive follow-on public offering in 2005. They issued over 14 million new shares at $295 each, raising something like $4.17 billion.
Huge numbers. These examples really show the strategic power these offerings hold, both for companies needing capital and for major investors looking to manage their positions.
Okay, now let's shift gears to the final and I think often surprising piece of this equity puzzle. What if you, as an investor, just can't afford a full share of a really expensive company? You know, like Berkshire Hathaway, trading for hundreds of thousands of dollars per share.
Yeah, that's a barrier for most people.
That's where fractional shares come in. And it's pretty much what it sounds like, right? Ownership of just a portion of a single share of stock.
Exactly.
Its main benefit seems crystal clear. It allows investors, especially those starting out or with limited capital, to buy into companies, even if their individual share prices are extremely high. It breaks down that barrier.
Absolutely. It's democratized investing in a big way. And fractional shares actually come about in a few common ways.
How so?
Well, dividend reinvestment plans, or DRIPs, often create them naturally. Your cash dividends are used to automatically buy more shares of the same stock, and that purchase amount might only buy, say, 0.2 shares.
Right.
They can also result from things like capital gain distributions from mutual funds, or if you're using dollar cost averaging, investing a fixed dollar amount regularly, which rarely buys exactly whole shares.
Okay, what else?
Stock splits don't always result in perfectly even numbers either. Imagine a company does a 3-for-2 split. If you owned, say, 3 shares before the split, afterwards you'd own 4.5 shares. There's your fractional share.
Okay.
And mergers and acquisitions frequently result in fractional shares too, because the exchange ratios for swapping shares of the acquired company for shares of the acquiring company are often predetermined and don't work out to whole numbers for everyone.
Got it. But maybe the most exciting development is brokers doing this intentionally.
Yes, that's been a game changer. Many brokerage firms now intentionally split whole shares of high-priced stocks on their own books specifically to make them accessible to more investors.
Like the examples you mentioned. Amazon, Google.
Exactly. I remember when getting even one share of Amazon felt like buying a small car. Think about Amazon trading at over $1,800 a share back in March 2020, or Alphabet, Google's parent, over $1,100.
Yeah, out of reach for many.
Totally. But with fractional shares, a young investor with maybe just $100 or $1,000 to invest could buy a small piece, say 1/10 or 1/3 of an Amazon share. This truly makes investing in these market titans possible for individual investors with limited funds.
So what are the practicalities? If I own, say, half a share of Amazon, how do I trade it?
Right, that's a key point. You generally can't trade fractional shares directly on the open market, like the NYSE or NASDAQ. You typically have to trade them through the specific major brokerage firm that holds them for you.
Okay, so through my broker's platform.
Yes, they usually aggregate fractional orders. Selling them might also take a little longer sometimes, especially if there's low demand for the stock at that moment, because the brokerage acts as the intermediary, matching up fractional buy and sell orders internally or handling the difference themselves.
And what about those fractional shares you might get from a split or merger?
In those cases, shareholders are often given the option to simply receive cash instead of the fractional share. It's called cash in lieu. But it's important to remember that cash payment is usually considered taxable income for that year.
Good to know. And which brokers really pioneered this?
Well, Interactive Brokers was one of the first really big online brokers to jump in and offer fractional shares trading back in November 2019. Fidelity followed pretty shortly after, in January 2020. Since then, many others have joined in. It's really opened up opportunities for diversification, allowing investors to build a portfolio across many companies, even expensive ones, with a small initial budget.
Okay, wow. We've covered a tremendous amount of ground today, haven't we? Feels like we went from the kind of fixed income nature and priority claims of preferred stock,
Yeah, the hybrid nature.
all the way to the liquidity implications of floating stock, understanding how many shares are really out there.
The trading aspect.
Then the strategic plays behind secondary offerings, whether it's the company raising cash or insider selling.
Dilutive versus non-dilutive, right?
And finally, wrapping up with the accessibility offered by fractional shares, breaking down those high price barriers.
It's quite a spectrum, and ultimately I think the power of understanding these distinctions lies in what they empower you, the listener, to do.
How so?
Well, understanding these different facets of equity isn't just, academic knowledge. It genuinely empowers you to make more informed investment decisions. You can better grasp the strategic choices companies are making when they issue different types of shares.
Right, it tells you something about their situation.
Exactly. And it helps you navigate the market with greater confidence. It really reinforces that stock ownership isn't just one simple thing. It's this dynamic spectrum of possibilities, each with its own unique characteristics and implications that can definitely impact your portfolio.
That's a great summary. So here's maybe provocative thought for you, our listener, to consider as you wrap up this deep dive with us.
Yeah.
Given all these diverse characteristics we've talked about, preferred, floating, secondary offerings, fractional shares, how might a company strategically use each of these tools to achieve its specific financial goals?
Yeah.
And maybe more importantly, what does the choice of tool tell you about that company's current state, its challenges, and maybe even its future ambitions? Something to chew on.